Welcome back to the deep dive. Today we're taking a deep plunge, uh, really getting into a cornerstone of the business world, partnerships and limited liability companies, specifically how they, navigate the intricate world of taxes.
Yeah, it's a big one.
You've given us a robust stack of sources that cut right to the chase, so our mission today is clear. We're going to try and demystify Subchapter K of the Internal Revenue Code and really unearth the core concepts that define how these entities, and more importantly, you as their owners, are taxed. Get ready for some, well, hopefully some truly profound aha moments that might just shift your perspective on business finance.
And what's truly fascinating here, I think, is the unique blend of advantages and, let's be honest, complexities these structures offer compared to, say, traditional corporations. Understanding the nuances of flow-through taxation isn't just about, like, ticking boxes for compliance. It's really a strategic imperative. We'll break down these often dense topics into truly digestible insights. We'll focus on why these distinctions matter for your bottom line and your long-term financial planning. It's a topic that directly impacts how countless small and medium-sized businesses operate, and critically, how their owners are personally taxed. It's everywhere.
Okay, let's start with the absolute bedrock concept then, the foundation that underpins most partnerships and LLCs,
Yeah.
this flow-through nature. What does that phrase truly mean for an individual owner, and why is it such a critical differentiator in the tax landscape?
That's a fantastic place to start, yeah, because flow-through truly is the cornerstone. Imagine your business profits like water. Okay.
Hmm.
In a traditional C corporation, that water pools in a corporate tank, right? And it gets taxed there at the corporate level. Then, when you want to take some of that water out as dividends, it gets taxed again at your individual shareholder level.
Right, the double tax it.
Exactly.
Yeah.
That's two layers of tax on the same dollar. But with a flow-through entity, like a partnership or most LLCs, that water just flows directly through the entity to your personal bucket. The partnership itself is explicitly not subject to income taxes. That's key. All of its income, gains, losses, deductions, it all just passes straight through to the partner's individual tax returns. That's where they're reported and taxed. Just once.
Okay, so if I'm understanding correctly, the fundamental benefit here is avoiding that infamous double taxation that C corporations face.
Precisely. This single level of taxation is a major, major reason why so many small and medium-sized businesses choose partnerships or LLCs, particularly startups, growing ventures. For a new business, this means their profits can be reinvested immediately without being hit by that second layer of tax at the corporate level.
Which helps growth, obviously.
Absolutely. It significantly accelerates their growth and capital retention. Think of it this way. For every dollar of profit, you might save, substantial cents by avoiding that second corporate tax. That allows you to retain more capital for expansion, maybe paying down debt, or even just personal investment compared to a C Corp. This simplicity and efficiency in taxation is incredibly appealing. It offers a significant cash flow advantage.
So it's not just corporations then. What kind of entities fall under this?
Well, we're talking about a broad category of unincorporated business entities here. They're all generally treated as partnerships under Subchapter K. This includes everything from, like, general partnerships where all partners have unlimited liability to limited partnerships, which involve both general and limited partners and, of course, the incredibly popular limited liability companies, or LLCs. These all benefit from this flow-through treatment by default.
That makes perfect sense. The cash flow advantage alone sounds like a real game changer. But, okay, if the partnership doesn't pay income tax itself, what's with the tax return? It feels like there's still a reporting requirement, right? What does Form 1065 tell us, and why is it so vital even if no tax is being paid at the entity level?
Yeah, that's where the concept of the information return becomes absolutely critical. It's a great question. Even though the partnership isn't cutting a check to the IRS for income tax, the IRS still needs a comprehensive accounting of the business's financial activities. Of course, that's why a partnership must still file a partnership tax return, which is Form 1065. Its main purpose is exactly that, to serve as a detailed informational return, not a tax payment vehicle.
Okay, so it's not about paying, it's about informing.
Right. It's like a master ledger that compiles all the partnership's income, expenses, gains, losses for the year. This form provides the granular detail necessary for the IRS to track the flow of income to the individual partners. Make sure everything adds up.
So it's essentially a blueprint of the business's financial year. And I understand this Form 1065 contains other key schedules, Schedules K and K1, I think.
Absolutely. Within this Form 1065, you'll find two absolutely critical components, Schedule K and Schedule K-1. Schedule K, it summarizes the partnership's overall income, deductions, credits, and other items broken down by type for all partners together. It's an aggregate summary, basically.
The big picture for the whole partnership.
Exactly. Schedule K-1, on the other hand, is where the rubber truly meets the road for you, the individual partner. And this raises an important question, like you said. How does an individual partner actually know what to report on their personal tax return if the partnership doesn't pay the tax directly? Well, that's where Schedule K-1 comes in. It acts like a detailed report card specifically for each partner.
Ah, okay, so the K-1 is my personal breakdown of what happened in the business, relevant to my taxes, my slice of the pie.
Precisely, your slice. Form 1065 indicates the exact amount and type of each partner's distributive share. That's the key term. Their share of the partnership's ordinary business income or loss, as well as any separately stated income, gain, loss, and deduction items. This means that each partner is then liable only for the taxes due on their specific distributive share as it's reported on that Schedule K-1. And here's a common point of confusion for many partners, one that often catches people off guard. You are liable for your share of the income regardless of whether the distribution is actually made to you by the partnership.
Wait, really? So even if I don't get the cash, I still pay tax on it?
Yes, even if the partnership decides to hold on to cash for reinvestment, maybe to pay down debt, you still pay tax on your share of the income that year. It's often called phantom income for that reason. You see it on paper, you pay tax on it, but the cash might not be in your bank account.
That's a crucial distinction. Wow, okay. It means my personal tax liability isn't necessarily tied to the cash I actually received from the business that year. So what exactly shows up on this K-1? Are all items just lumped together?
Not at all. And this is where the precision of partnership taxation truly shines. Our sources have a really helpful chart showing key pass-through items and how they're reported. It distinguishes between items that contribute to ordinary business income or loss and those that are separately stated items.
Okay, so two main buckets, ordinary business income first.
Right. Ordinary business income or loss is basically the net income or loss from the partnership's core operations. This is the big number that generally reflects the day-to-day profit or loss of the business. It appears on Form 1065, then Schedule K, and finally on your individual K-1. You'll also see guaranteed payments to partners, which we should definitely get into more detail on shortly. These also appear on all three forms.
Okay, and the other bucket, separately stated items. Why separate them?
Good question. This category, the separately stated items, is critical because these items retain their individual character when they flow through to your personal tax return. Why are they separated out? Because you, as the individual partner, will treat them on your personal tax return according to your own personal tax circumstances and limitations.
Ah, so my personal situation matters for these specific items.
Exactly. For instance, your ability to deduct charitable contributions or maybe investment interest expense might be limited based on your individual adjusted gross income or AGI or other factors on your personal tax return. The partnership doesn't just lump these into ordinary income because that would prevent you from applying your specific individual tax rules correctly.
So it's about maintaining the character of the income or expense so that it's treated correctly on my personal return rather than just being generic business income. Can you give us some examples of these separately stated items? What kind of things are we talking about?
Certainly. This category includes things like net rental real estate income or loss, which is almost always separately stated. That's a big one. Then there's interest income, dividend income, and capital gains and losses. These are often investment-related items that typically have different tax rates or rules for individuals.
Right, like lower capital gains rates.
Precisely. Also, net Section 131 gain or loss. This one's interesting. Think of Section 1231 as the tax code's way of giving you, the best of both worlds for certain business property sales. If you sell it for a gain, it can be treated like a capital gain, often taxed at a lower rate. If you sell it for a loss, it can be an ordinary loss, which is great because it's fully deductible against other income.
Huh, that's a nice perk.
It really is. It's a strategic area for businesses with significant assets, and it's separately stated so you can potentially get that favorable treatment on your personal return. Other examples include charitable contributions, the Section 179 expense deduction that allows immediate expensing of certain assets instead of depreciating them over time. Investment interest expense, partners' health insurance premiums, retirement plan contributions for employees and partners, and various tax credits. Each of these items is reported separately so you can apply your unique tax situation and any applicable limitations. It's all about maximizing your tax efficiency, really. It shows the IRS wants precision in reporting.
That level of detail on the K-1 is clearly essential for good personal tax planning. Now, you mentioned guaranteed payments to partners a couple times. They sound a bit like a salary, but I gather they have a very specific tax identity for a partner. What exactly are they, and how do they differ fundamentally from a regular employee salary?
Yeah, this is a frequently misunderstood area, definitely trips people up, and it's crucial to get it right. Guaranteed payments are defined as reasonable compensation paid to a partner for services they've provided to the partnership, or maybe for the use of their capital. And here's the crucial differentiator. It's paid without regard to the partner's profit or loss sharing ratio.
Ah, okay. So it's not tied to how well the business did that year.
Exactly. That immediately sets it apart from a typical distribution of profits, which is directly tied to the partnership's actual income. So even if the partnership has a tough year and generates no profits or even a loss, if you're contractually entitled to a guaranteed payment, you still receive it. They have this kind of dual nature in the tax world, makes them quite unique. They are an allowable tax deduction to the partnership.
Which is good for the business.
Right, a benefit for the business. And they are a taxable income to the partner receiving it.
That, without regard to profit or loss clause, really highlights why it's not just a profit distribution.
Yeah.
So how does this dual nature impact the partnership's tax return and the partner's individual return? What does it look like in practice?
Well, the tax treatment of guaranteed payments is where their unique nature really shines. It illustrates the careful attention to detail required in partnership taxation. From the partnership's perspective, these payments are indeed allowable deductions, just like salaries for employees. This applies whether the payment is for services basically acting like a guaranteed salary for the partner's work or for the use of a partner's capital, more like a guaranteed interest payment on a loan the partner might have made to the partnership. Importantly, this deduction is taken without regard to the partnership's income or its profit and loss sharing ratios.
So the partnership deducts it even if it has zero income.
Yes, the partnership can deduct these payments even if it has no taxable income for the year. This also includes a slightly less common situation: the fair market value of any capital partnership interest that might be issued in exchange for services contributed by a partner. That also gets treated this way.
Okay, that's the partnership side. What about for me as the partner getting the payment?
Right. For you as the partner, these guaranteed payments are reported directly on your Schedule K-1. They are included as ordinary income, meaning they're subject to income tax at your regular individual rates. Now, a key point to remember here is that they may also be included as part of your net earnings from self-employment.
Ah, self-employment tax, so Social Security and Medicare.
Exactly. This is vital because it can affect your self-employment tax obligations, covering those contributions. And one more critical distinction: this one often catches people out, especially with recent tax law changes.
Okay.
Guaranteed payments for services are not included in qualified business income or QBI for the purposes of the Section 199A QBI deduction.
The 20% deduction. Guaranteed payments don't count for that.
Correct. That 20% QBI deduction is a significant tax break for many flow-through business owners, so knowing that guaranteed payments specifically don't qualify for that deduction is vital for accurate tax planning. It's a big deal.
All these rules can feel a bit abstract until you see them in action. Luckily, we have a great example from our sources to illustrate how a partnership actually calculates its ordinary business income and identifies those separately stated items. Let's walk through it with ordinary income calculation example 1. Can you set the scene for us? What are the numbers for Acme Partnership?
Certainly. Let's look at Acme Partnership for a given year. Here's what they reported. Gross business income, $250,000. Dividend income, $8,000. Salary expense, this is for employees, not partners, $50,000. Guaranteed payments to partners, $35,000. Rent expense, $15,000. Depreciation expense, $10,000. Section 179 deduction, $30,000. And charitable contributions, $20,000.
Okay, quite a few items there.
Yeah. So the first step is to calculate the partnership's ordinary business income. This is the income generated from its core trade or business activities, the main operations. We start with the gross business income of $250,000. From that, we subtract the ordinary and necessary business expenses. The salary expense for employees, $50,000. That's a direct deduction. The guaranteed payments to partners, $35,000, are also a deduction for the partnership, even though they're income to the partner.
Right, that distinction again.
Exactly. This is a common area of confusion. Sometimes people think because it's income to the partner, it's not a deduction for the partnership, but it absolutely is, just like an employee salary for the partnership's calculation of ordinary income. So we subtract that $35,000. We also subtract the rent expense of $15,000 and the depreciation expense of $10,000.
Okay, so if I follow that, $250,000 gross income
Hmm.
minus $50,000 salary, minus $35,000 guaranteed payments, minus $15,000 rent,
Right.
minus $10,000 depreciation.
Yeah.
What does that bring us to?
Let's see. 250K minus 50K is $200 K, minus 35K is 165K, minus 15K is $150, minus $10. Yeah, that calculation yields an ordinary business income of $140,000 for the Acme partnership. This is the net operational profit that will then flow through to the partners as part of their ordinary business income share on their K-1s. This figure is what forms the basis of, well, a lot of the partners' overall taxable income from the business.
All right, so $140,000 is the core operational income. Now, what about those separately stated items you mentioned earlier? Based on these facts for Acme, which items are pulled out and stated separately?
Good question. Looking back at the facts for Acme Partnership, the separately stated items are the $8,000 in dividend income. Remember, that's investment income, not core business operations.
Right.
The $30,000 Section 179 deduction. That immediate expensing has its own rules and limitations for the partner. The $20,000 in charitable contributions, just like on your personal return, this is an itemized deduction for the partner, handled separately. And crucially, those $35,000 in guaranteed payments to partners.
Even though they were deducted to get to the 140K.
Exactly. Even though they were a deduction for the partnership in calculating its ordinary business income, they're also separately stated on Schedule K and then on each partner's K-1. This is because, as we discussed, they are taxable directly to the partner, they often have self-employment tax implications, and they don't qualify for the QBI deduction, so they need their own line.
That example beautifully illustrates how the partnership consolidates certain items into ordinary business income for the entity, but then meticulously separates out others.
Yeah.
Why is it so vital, again, that you, as the partner, treat these separately stated items based on your unique circumstances? Why not just take the partnership's word for it?
Well, because your personal tax situation might limit how much of that Section 179 deduction or charitable contribution you can actually claim in a given year. For example, Section 179 has a taxable income limitation at the partner level. You generally can't deduct more Section 179 expense than your aggregate business income from all sources. If the partnership just lumped it all into ordinary business income, you wouldn't have the granular detail necessary to apply your personal tax rules. You wouldn't know what made up that income. If the partnership were to combine all items into a single net number, it would obscure the character of certain income and deduction items. This would prevent partners from taking advantage of specific tax benefits, like lower capital gains rates, or being subject to specific limitations, like passive activity loss rules for rental income on their personal returns.
Got it.
This distinction is truly fundamental in partnership taxation for accurate and, frankly, optimized individual tax reporting.
Okay. Now, beyond the day-to-day operations, starting and running a business involves specific expenditures, especially in those crucial early years. Let's talk about organizational expenditures and startup costs. What's the general rule here? How does the tax code treat those initial setup costs?
Right. When you're just getting a partnership off the ground, you're going to incur certain expenses before you even open your doors for business or make your first sale. The good news is the tax code recognizes this. It allows the partnership to elect to deduct a portion of these immediately. Specifically, you can deduct up to $5,000 each for organizational expenditures and another $5,000 for startup costs in the year the business begins.
$5,000 each. That sounds helpful up front.
It is. This immediate deduction provides a valuable upfront tax benefit when you're likely facing significant initial cash outflows.
But it's not always the full $5,000, is it? I feel like there's usually a catch with these things. A phase out, maybe?
You got it. Exactly. There's a phase out. Each $5,000 immediate deduction amount is reduced, dollar for dollar, by the amount by which the total cost for that specific category organizational or startup exceed $50,000.
Okay, can you give an example?
Sure. Let's say your organizational expenditures, like legal fees for the partnership agreement, total $53,000. That $53,000 exceeds the $50,000 threshold by $3,000. So your initial $5,000 immediate deduction is reduced by that $3,000, $50,000. That leaves you with only a $2,000 immediate deduction for organizational costs in that first year.
And what happens to the rest? The amount over the $2,000 in that case.
Any remaining organizational expenditures or startup costs, meaning anything above that deductible amount after applying the phase-out, must then be amortized. That means spread out. You amortize them over 180 months, which is 15 years.
15 years.
Yeah, it's a long time. And this amortization period begins in the month the active trade or business officially starts. So it's a long-term deduction for the bulk of these initial costs if they're substantial.
And what exactly counts as an organizational expenditure versus a startup cost? I imagine the IRS is pretty specific about what falls into each bucket.
They are indeed. You need to categorize correctly. Our sources clarified that allowable organizational expenditures generally include things like fees for legal services, such as drafting the partnership agreement, fees for accounting services related to setting up the initial books, and any fees paid for partnership filings with the state. Think of these as the essential costs to legally set up and register the business as a partnership entity.
Okay. The structural setup costs and startup costs.
Startup costs, on the other hand, are expenses incurred prior to the opening of the business, but relate more to getting it ready to operate. These can include things like training costs for employees who will run the business, advertising costs to launch and introduce the business to potential customers, maybe travel costs to secure suppliers, and even testing costs to ensure your product or service is ready for market before you officially open. These are all expenses that, if you incurred them after the business opened, would typically be deductible as ordinary business expenses right away.
I see. Is there anything that specifically doesn't count?
Yes, and it's important. It's explicitly noted that syndication costs are not deductible here. Syndication costs are things related to selling or marketing the partnership interests themselves, like preparing offering materials, prospectus printing, brokerage fees to find investors.
Wow, raising capital costs.
Exactly. Those are specifically not deductible at all, neither immediately nor through amortization over time. The IRS views these as capital costs related to acquiring equity, not operating expenses. They just reduce the capital raised.
This whole area of startup and organizational costs seems often overlooked, but it can have a significant impact on early-stage profitability and cash flow. How critical is it for a new business to properly categorize and track these initial expenditures?
Oh, it's absolutely crucial for managing your tax liability as a new business. Knowing exactly what you can deduct immediately versus what you must amortize over 15 years directly affects your taxable income in those critical first few years. Properly classifying these initial expenses can literally mean the difference between reporting a small profit or maybe a larger loss in the startup phase, which in turn impacts your tax bill. Failing to take these deductions correctly or misclassifying them can leave money on the table, money that you probably desperately need for a burgeoning partnership's financial health and cash flow.
Right, paying tax sooner than needed.
Exactly. It can mean paying taxes sooner than you need to, or not maximizing your deductions when they could be most beneficial, like offsetting initial income.
And for many of you operating a flow-through business, there's another valuable deduction on the table we touched on, the Section 199 Qualified Business Income, or QBI, deduction. Can you briefly remind us about this, specifically as it applies to partners?
Sure. The QBI deduction, which came in with the Tax Cuts and Jobs Act back in 2017, is a pretty significant benefit for owners of flow-through entities like partnerships and S-Corp, and also sole proprietors. It allows a partner or LLC member to potentially take a deduction. It's a below-the-line deduction, meaning it reduces your adjusted gross income of up to 20% of their qualified business income. This applies to the ordinary business income that flows through from a partnership or LLC. It does not apply to investment income like dividends or capital gains generally.
It could really lower your tax bill.
It definitely can. For many small business owners, this is a substantial tax saving. And just to quickly reiterate what we mentioned earlier because it's important, guaranteed payments for services are not included in QBI for the purpose of calculating this deduction.
That's a huge potential deduction for so many businesses.
Yeah.
But are there any complexities or limitations that a listener should be aware of? It sounds almost too good to be true.
Well, while it's a fantastic 20% potential deduction, it's certainly not without its complexities. It's definitely not simple for everyone. The QBI deduction is subject to various limitations based on, first, your individual taxable income. Once your income goes over certain thresholds, other limits kick in. Also, whether you operate what's called a specified service trade or businesses or SSTB.
That falls into that category.
That includes many professional services like health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services. Basically, fields where the principal asset is the reputation or skill of employees or owners. For those SSTBs, the deduction phases out completely at higher income levels. And for all businesses, once you're above the initial income thresholds, the deduction can be limited by either the amount of W-2 wages paid by the business or a combination of W-2 wages and the unadjusted basis of qualified property the business owns.
Okay, so it gets complicated quickly.
It really does. And understanding these income thresholds, the SSTB rules, and the wage property limitations is crucial for maximizing this benefit, especially as your business grows and your income rises. It's definitely a prime area where getting professional tax advice can really pay off, just to make sure you're navigating it correctly and claiming everything you're entitled to.
That's great context, very helpful. Now, let's bring it all together with some real-world application. Our sources provide excellent diagnostic reports from a tax preparation software showing common errors and important distinctions. This is where the rubber meets the road, right, where you see why these details matter so much. Can you walk us through the scenario of Carlos, the CPA, preparing Acme Partners' tax return? What did he run into?
Absolutely. Let's imagine Carlos. He's a seasoned CPA, and he's preparing Acme Partners Year 2 Form 1065. It's a calendar year general partnership, two equal partners, and they're both actively participating, so they're hands-on in the business. Carlos runs his diagnostic report on the tax software like many preparers do, and immediately a few alerts pop up. They signal potential issues that could significantly impact the partner's tax returns if not corrected. And honestly, these are errors I've seen countless times in practice. Very common pitfalls.
Okay, what's the first common mistake Carlos's software flagged?
The first issue he encounters concerns net rental real estate income. The problem flagged was that $35,000 of net rental real estate income was incorrectly entered as other income on page 1 of Form 1065. Because of that placement, it was mistakenly included in the calculation of ordinary business income for the partnership.
Instead of being separate.
Exactly, and simultaneously, no amount was entered on Schedule K, line 2, which is the specific designated line for net rental real estate income. The software immediately flags this because it knows rental income typically isn't part of core ordinary business income and should be stated separately.
Okay, so how does Carlos fix that?
The correction Carlos needs to make is straightforward but critical. He needs to move that $35,000, take it out of the other income line on page 1 and put it onto Schedule K, line 2. There, it will be properly reported as a separately stated item, which then flows to the partner's K-1s on the correct line. The crucial takeaway here for you is that net rental real estate income, regardless of whether the partnership is primarily a rental business or just has some incidental rental income, is always a separately stated item. Always.
Why always?
Because rental activities can be subject to specific rules on a partner's individual return, like the passive activity loss limitations. Lumping it into ordinary business income would have effectively bypassed those rules. It could lead to incorrect deductions or incorrect application of limitations for the partner, so it must be separate.
That first issue really highlights how critical proper income classification is. It's not just about the total number. Okay, moving on to issue 2. This one hits on our earlier discussion about guaranteed payments versus employee salaries. What did Carlos find here?
This is another incredibly common misclassification. Happens all the time. The problem Carlos saw was that $50,000 was entered on Form 1065, page 1, line 9. That line is for salaries and wages, implying it was for regular employees. Meanwhile, the line right below it, line 10 for guaranteed payments to partners, had $0 entered. And crucially, there was no entry for guaranteed payments on the individual partner's K-1s.
So the software flagged that mismatch.
Exactly. The software, recognizing this potential inconsistency paying partners but calling it wages, prompted Carlos to confirm that these amounts should indeed be zero for guaranteed payments. The correction here is vital. Carlos has to dig a bit deeper. He must confirm if that $50,000 was actually employee wages. If, as is often the case with small partnerships, it was actually guaranteed payments made to the partners themselves for their services. Which seems likely if they're active partners.
Right, then it needs to be reclassified. It should be shifted from salaries and wages, line 9, to guaranteed payments to partners, line 10, on Form 1065, page 1. And then just as importantly, those amounts must be entered for each respective partner on their individual K-1s, specifically on line 4A, the guaranteed payments line.
So even though both reduce the partnership's ordinary income on page 1, the downstream impact on the partner's K-1 and their personal tax return is completely different.
Completely different, exactly. The key takeaway for you is this. Both salaries, wages for employees, and guaranteed payments to partners are deductions when calculating the ordinary business income or loss on page 1. Yes. However, the critical distinction for you as a partner is that guaranteed payments to partners are also a separately stated item on Schedule K and included on the recipient partner's Schedule K-1 as taxable gross income.
And subject to self-employment tax, usually.
And usually subject to self-employment tax, exactly. Whereas regular employee wages are subject to payroll taxes withheld by the partnership. Misclassification can lead to incorrect reporting for both the partnership and the individual partners. It significantly impacts their ordinary income calculation, how their share of profits is determined, and crucially, whether certain amounts are considered net earnings from self-employment. Getting this right ensures both the entity and the individual are compliant and accurately reflecting their true tax situation.
And finally, Issue 3 brings in the concept of active participation and self-employment earnings. What was the problem here, and what's the real-world implication for the partners?
Okay, here, the problem was that Schedule K-1, line 14, which is specifically for reporting self-employment earnings, was left blank for both partners. However, elsewhere on the K-1, the boxes indicating that both partners were actively participating in the business operations were checked.
Ah, so a contradiction. Active participation, but no self-employment income reported.
Exactly. It's a clear contradiction that the tax software caught. If you're actively participating as a general partner or often as an LLC member, your share of the business income and any guaranteed payments for services are generally considered self-employment income. The correction for Carlos is usually straightforward in the software. Remove whatever override or code caused line 14 to be left blank. This allows the software to correctly calculate and populate the self-employment earnings based on the ordinary income and guaranteed payments flowing through.
Okay, and the big takeaway.
The key takeaway here is vital for anyone who is an active partner. For actively participating partners, both their share of ordinary business income and any guaranteed payments received for services should generally be included in their net earnings from self-employment. This has direct implications for self-employment tax. Again, that's the Social Security and Medicare taxes for self-employed individuals. If you're actively involved in the day-to-day operations, the IRS expects you to report these earnings and pay self-employment tax on them, just as a sole proprietor would on their Schedule C income.
And if you don't?
Failure to include these amounts in self-employment earnings could lead to underpaying self-employment taxes, which then result in penalties and interest down the line. It's really about ensuring that the economic reality of the partner's active involvement is accurately reflected in their tax filings.
These real-world scenarios perfectly highlight the interconnectedness of all these tax rules. One entry impacts another down the line. Okay, let's shift gears slightly. Let's talk about a foundational concept for every single partner: your tax basis in the partnership. You mentioned it briefly. Think of it like your personal investment accounting for the business. What exactly is this basis, and why is it so critically important for you as a partner?
Right. Your tax basis in a partnership interest is, it's your personal accounting measure of your investment in that partnership. It tracks your stake, economically speaking, for tax purposes. Simply put, a partner's basis in their partnership interest includes their capital account plus their share of any partnership debt.
Okay, capital account plus debt. What's the capital account part?
Your capital account reflects your direct investment in the partnership, basically, what you've put in through contributions, adjusted for your share of the partnership's income or loss over time, and reduced by any distributions you've taken out. But the inclusion of debt is what makes a partnership basis really unique and, frankly, powerful compared to, say, a shareholder's basis in a C corporation stock.
How so?
For a C Corp shareholder, the corporation's debt usually doesn't increase the shareholder's stock basis at all. But for a partner, your share of partnership debt generally does provide additional basis, and that's incredibly powerful for tax purposes.
So my share of the partnership's debt is literally treated as part of my investment for basis purposes. That seems like a big deal.
Yeah.
Are there different kinds of debt that factor into this differently?
Yes, exactly. It's a crucial distinction and a huge advantage. Your share of partnership debt includes two main types that can significantly impact your basis calculation. First, there's debt for which you have personal liability. We call this recourse debt.
Meaning the creditors can come after me personally.
That's right. If the partnership can't pay the debt, the creditors can come after the partners who have liability, typically general partners, or anyone who personally guarantees the debt for their share. Because you bear that economic risk of loss, it increases your basis. Second, there's your share of partnership debt that is secured by partnership property, but where you might not have personal liability beyond that property. This is generally called non-recourse debt.
Like a mortgage on a building owned by the partnership.
Exactly. Think of a mortgage on partnership property where the bank's only recourse, if the loan defaults, is to seize the property. They can't come after the partners personally for any shortfall, generally. Even though you don't have direct personal liability for non-recourse debt, you still generally get basis for your share of this debt, usually allocated based on your profit-sharing ratio or other complex rules. This can be particularly beneficial for, say, real estate partnerships or other ventures with significant secured loans. It boosts your basis significantly.
That inclusion of debt in basis is clearly a huge advantage for partnerships. Why is tracking this basis so meticulously? Why can't I just keep a running tally of my cash contributions and distributions? Seems simpler.
Because it's such a dynamic number, it constantly adjusts up and down, and those adjustments have direct tax consequences for you.
Yeah.
Particularly around deducting losses or receiving distributions tax-free. It's not a static figure you calculate once. Your basis is in constant flux throughout the year, every year. Our sources provide a helpful passkey analogy here, which I like. Think of your partnership interest like a bank account.
Okay.
Income items and increases in your share of debt are like deposits. They increase your account balance, your basis. Conversely, withdrawals, meaning distributions you receive, and your share of loss and deduction items, along with decreases in your share of debt, are like withdrawals that reduce your basis balance.
Deposits and withdrawals. I like that. Could you be more specific? What increases basis?
Sure, your basis will increase with any additional contributions you make to the partnership cash or property, your share of income and gain items. This includes your share of ordinary business income, separately stated income, and gains, like capital gains or dividends. And interestingly, even your share of tax-exempt income the partnership earns, like municipal bond interest. Even though it's not taxed, it still increases your basis.
Huh. Okay. And debt.
And, as we discussed, increases in your share of partnership debt. That's a big one for basis increase.
Okay. And what makes the bank account balance go down? What decreases basis?
Right, the withdrawals. Your basis will decrease with distributions you receive from the partnership, whether it's cash or property. Note, distributions are generally tax-free up to your basis amount.
Ah, okay. So basis limits tax-free distributions too.
It does. Basis also decreases by your share of loss and deduction items, things like ordinary business loss, separately stated losses and deductions, like that section of 179 or charitable contribution, and also certain non-deductible expenses that aren't capital expenditures, like maybe fines or penalties the partnership had to pay.
Okay.
And of course, if your share of partnership debt decreases, maybe the partnership pays down loans, that reduces your basis too.
So income, while taxable, increases your basis. And distributions, even though they're generally non-taxable to the extent of your basis, directly decrease it. It's a constant adjustment. To really make this concrete, let's run through an example of how a partner's basis changes over the year. This is where it's really interesting, seeing it all come together. Let's look at example 2, partner's basis and partnership interest involving Rick Jones. Can you lay out the facts for Rick?
Excellent idea. This example truly brings the concept of basis adjustments to life. Okay, here are the facts for Rick Jones. Rick is a 50% partner in Acme General Partnership. He started year 1 with an initial cash contribution of $50,000. The total partnership debt was $20,000 at the beginning of year 1, and it increased to $25,000 by the end of year 1. Now, for the partnership's year 1 activity, remember from example 1, Acme had $140,000 in ordinary business income, $8,000 in dividend income, a $30,000 Section 179 deduction, and $16,000 in charitable contributions. Slight change from X1 source for basis calc. On top of that, Rick personally received $18,000 in cash distributions from Acme during year 1, and he also received that $15,000 guaranteed payment we discussed.
Okay, that's a lot of moving parts, lots of deposits and withdrawals for his basis bank account. So how do we calculate Rick's year 1 ending basis step by step?
Right. First, we need to determine Rick's 50% share of all those partnership items, since he's a 50% partner. His share of ordinary business income is $140,000 times 50%, which is $70,000. His share of dividend income is $8,000 times 50%, or $4,000. For the Section 179 deduction, his share is $30,000 times 50%, which is $15,000.
And his share of charitable contributions is $16,000 times 50%, or $8,000.
Okay, got his shares. Now build the basis.
Okay, let's build Rick's basis step by step, starting with his initial investment and adding the deposits and subtracting the withdrawals. 1. Start with his initial cash contribution, $50,000. That's his direct capital investment. 2. Add his share of the beginning partnership debt. The total debt was $20,000 at the start. His 50% share is $10,000. 3. Initial year 1 basis. This gives him a starting point, his initial year one basis and his partnership interest of $60,000, $50,000 plus $10,000 debt share.
60K starting point. Got it. Now the adjustment.
Okay.
Exactly. Now, for the adjustments throughout the year, generally applied in a specific order, increases first, then distributions, then loss deductions. 4, add the increase in his share of partnership debt. The total partnership debt increased from $20,000 to $25,000. That's a total increase of $5,000. Rick's 50% share of this increase is $2,500. So we add that, basis goes up. 5, add his share of the ordinary business income. This is a huge increase to basis. Add $70,000, 6 cents. Add his separately stated dividend income. Another increase, add $4,000. Okay, now the decreases. 7, subtract cash distributions. Rick received $18,000 in cash distributions. These are withdrawals from his account, so we subtract that $18,000 share. 8 cents. Subtract his separately stated Section 179 deduction. This deduction flows through and reduces his basis by his $15,000 share. 9, subtract his separately stated charitable contributions. Another reduction, subtract his $8,000 share.
Wow, that's a lot of moving parts.
Yeah.
So after all those additions and subtractions, starting at 60K, adding the debt increase, adding the income, adding the dividends, subtracting distribution, subtracting deductions, what's Rick's ending basis for year one?
Yeah.
Where does he land?
Okay, let's tally it up. $60,000 initial basis, plus $2,500 debt increase, plus $70,000 OBI, plus $4,000 dividends. That brings us up to $136,500. Then subtract $18,000 distributions. Subtract $15,000 Section 179. Subtract $8,000 charitable contributions. Rick's year one ending tax basis and his partnership interest comes out to $95,500. Recalculating based on numbers given, let me recheck that. $60K plus $2 for 5K, so $7K plus 4K equals $136 5Ks. Then $136 5K, 18K is $118 500, 15K is $103 5Ks, $103 5K. 8K is $95,500.
Okay, $95,500.
Yep.
And the guaranteed payment he received, where did that fit in?
Good catch. Notice that the $15,000 guaranteed payment Rick received was already factored into the partnership's calculation of ordinary business income. Back in example 1, it was a deduction for the partnership. So when we added Rick's $70,000 share of the net ordinary business income to his basis, the effect of that guaranteed payment deduction was already baked into that $70,000 number. It reduced the partnership's income, thus reducing Rick's share slightly. It's not a separate line item for increasing or decreasing basis in this calculation because its impact is reflected within the ordinary business income figure. It's taxable income to him, yes, but its effect on basis is through the net income calculation.
Got it. It's embedded in the OBI number. Okay, so why is tracking this $95,500 basis number so crucial for partners like Rick? I can see it's complex, but what's the big picture impact? Because it directly impacts how much loss you can claim on your personal tax return, right? That seems to be the main thing.
Absolutely. That is perhaps one of the most critical reasons to meticulously track your basis, the tax basis limitation rule. This rule states very clearly that a loss from the partnership, your distributive share of an ordinary business loss or separately stated losses, can only flow through to your individual income tax return and be deducted to the extent of your tax basis in your partnership interest at the end of the partnership's tax year.
So your basis acts like a ceiling for deducting losses.
Precisely, a ceiling. So if the partnership generates a significant loss in a given year, maybe $100,000 is your share, but your basis is only, say, $40,000 before considering loss. You can only deduct $40,000 of that loss on your personal tax return in that year. Your basis would go down to zero, and the remaining $60,000 loss is stuck.
So what happens to that excess loss, the $60,000 in that example? If my basis isn't high enough, is it just lost forever? Poof.
Not necessarily lost immediately, thankfully, but it is suspended. Any loss in excess of your basis is held in limbo, basically put on hold, until your basis is reinstated in future years. The good news is that a suspended loss due to insufficient tax basis can be carried forward indefinitely. It just sits there waiting for you to have enough basis to absorb it.
Okay, so how do you reinstate basis to use those suspended losses later?
Well, through any of the items that increase basis, which we talked about earlier, your future share of ordinary business income, your future share of separately stated income and gains, any additional capital contributions you make to the partnership, or, significantly, an increase in your share of partnership debt. So if the partnership turns profitable the next year, or you contribute more cash, or the partnership takes on more debt that you get allocated, your basis increases, and you can potentially utilize those previously suspended losses against that new basis.
So they carry forward indefinitely, but is there any way you do lose them?
Yes, and this is a crucial point that you need to be acutely aware of, especially when planning an exit. Any suspended losses due to basis limitations that remain suspended when the partner disposes of their entire partnership interest, meaning they sell it, or it gets liquidated, or maybe they gift it or die, those remaining suspended losses are generally lost forever. You cannot claim them at the point of disposition.
Wow. Okay, so you need basis before you get rid of the interest to use those losses.
Exactly. This highlights the importance of proactive tax planning and basis management, especially if you anticipate leaving a partnership that has generated losses you haven't been able to deduct yet. You might need to strategize ways to increase basis before the disposition. And it's also worth noting again that nuance about debt inclusion, tying back to our earlier discussion.
Right, recourse versus non-recourse, general versus limited partner.
Precisely. A partner's share of partnership debt that's included in their basis depends heavily on the type of partner you are, general partner, limited partner, LLC member treated as a partner, and the type of debt itself, non-recourse, recourse, or maybe non-recourse debt that you've personally guaranteed. General partners typically get basis for both recourse and non-recourse debt allocated to them. Limited partners or LLC members who generally have limited liability might have more restrictions on including recourse debt in their basis unless they personally guarantee it or have an obligation to restore a deficit capital account. This difference can significantly impact how much basis you have and therefore how much loss you can claim. It requires careful attention to the partnership agreement and the loan documents as it affects the overall amount of skin in the game the IRS recognizes you have.
This basis limitation is clearly a critical protective measure in tax law. It prevents partners from claiming paper losses far beyond their actual economic investment or risk. For you, the listener, understanding this limitation means avoiding potentially unwelcome surprises at tax time. It truly highlights the importance of not just tracking profits, but also your actual capital investment and those crucial debt allocations within the partnership. You might feel the economic sting of a loss, but if your tax basis isn't sufficient, the IRS won't let you claim the deduction on your personal tax return until that basis is restored. It's a fundamental rule. Okay, finally, let's bring in the limited liability company, or LLC. They've become incredibly popular for businesses of all sizes, seem to be everywhere now. But how are they taxed, and how do they fit into this broader partnership conversation we've been having today? Can you explain the fundamental structure of an LLC? What makes it different?
An LLC is a fascinating hybrid structure, legally speaking. It's recognized as a separate legal entity from its owners, who are called members, not partners or shareholders. This distinction is a huge reason for their popularity. It generally means LLC members are not personally liable for the obligations, the debts, and lawsuits of the business.
The limited liability shield.
Exactly. This is similar to corporate shareholders, where your personal assets, your house, your car, your savings are generally shielded if the business gets sued or can't pay its bills. This limited liability is a key difference from a general partnership, where all general partners are personally liable for all partnership debts. Even in a limited partnership, while the limited partners have limited liability, there still needs to be at least one general partner who carries that full personal responsibility. With an LLC, all members generally enjoy that coveted limited liability protection, which is a huge draw.
So it gives you the legal protection of a corporation, but without necessarily being taxed like one. This is where the flexibility comes in, I assume. That sounds pretty appealing.
This is exactly where it gets really interesting and why they're so popular. While LLCs offer that limited liability similar to a corporation, their tax treatment is far more flexible. The Internal Revenue Code doesn't actually have a specific LLC tax category, which surprises many people. There's no Form 1120 LLC or anything like that.
Really? No specific tax rules just for LLCs?
Nope. So they essentially get to pick how they want to be taxed through what are called the check-the-box regulations, or the IRS makes a default classification for them if they don't choose. This flexibility is a huge advantage for businesses choosing the LLC structure, as it allows them to tailor their tax situation to their specific needs and circumstances.
Okay, so what are the options? How can an LLC be taxed?
For federal income tax purposes, an LLC can generally be treated as one of three things, depending on its number of members and any elections it makes. One, as a partnership. This is the default rule for an LLC, with at least two owners, a multi-member LLC. If you form an LLC with someone else and don't tell the IRS otherwise, it's automatically taxed as a partnership.
So all the rules we just talked about apply. Form 1065, K-1s, flow-through.
Exactly. It falls under all the subchapter K flow-through rules we've been discussing today. It files a Form 1065, issues K-1s to its members, and its income and losses flow directly to the members' personal returns, avoiding that corporate double taxation. This is, by far, the most common choice for multi-member LLCs, too. as a corporation. Now, a multi-member LLC can elect to be taxed as a C corporation instead. Sometimes, rarely, there might be strategic reasons for this, maybe related to reinvesting all profits or specific fringe benefits, but it's less common for smaller businesses because it brings back that double taxation issue.
And how did they make that choice?
This election to be taxed differently from the default, either as a C Corp or sometimes an S Corp, which has its own set of rules, is generally made on Form 8832, called the Entity Classification Election, the check-the-box form. 3. As a disregarded entity sole proprietorship. Now, what about a single-member LLC, an LLC with only one owner?
Yeah, what happens then?
A single-member LLC is considered a disregarded entity for federal income tax purposes by default.
Disregarded. What does that mean?
It means that for tax purposes, the IRS generally ignores the separate legal entity of the LLC and treats the business activity as if it were conducted directly by the owner. So, if the single owner is an individual, the single-member LLC is treated just like a sole proprietorship. All the business income and expenses are reported directly on the individual's Form 1040 using Schedule C, profit or loss from business. It's very straightforward. If the single owner of that LLC is, say, a C corporation, then the LLC's income and expenses are simply included right in the C corporation's own tax return, Form 1120. The LLC itself doesn't file a separate federal income tax return.
Wow. Okay, so disregarded means it doesn't file its own tax return. It just flows onto the owner's return.
Precisely. That flexibility, especially the default partnership or disregarded entity treatment, is a huge advantage for businesses choosing the LLC structure.
So what does this all mean for you as a business owner or potential owner? It sounds like an LLC really does give you the best of multiple worlds in many cases.
It absolutely can, yeah. It means an LLC often gives you the best of both worlds. You get the crucial limited liability protection for your personal assets, similar to what a corporation provides, shielding you from business debts, and you get tremendous flexibility in choosing your tax treatment. Very often, businesses opt for that default flow-through partnership structure for multi-member LLCs or disregarded entity status for single-member LLCs that we've been deep diving into today. This lets them enjoy the single level of taxation, avoiding corporate double taxation, while still maintaining that crucial personal liability shield. This powerful combination of legal protection and tax flexibility really explains their widespread adoption across almost every industry you can think of. It allows you to tailor your business structure to your specific operational and financial goals, protecting your personal wealth while hopefully optimizing your tax situation.
And that wraps up our deep dive into the, well, sometimes complex but absolutely fascinating world of partnership taxation and LLCs. We've unpacked quite a bit today, everything from the foundational concept of flow-through entities, the critical Form 1065, and those all-important K-1s, to the specific nuances of guaranteed payments, those meticulous basis calculations, and even tackled some common real-world tax issues that often pop up for practitioners like Carlos.
Yeah, our goal was really to make these concepts, which can seem really dense on paper, more understandable, and hopefully give you those aha moments about why these distinctions matter so much for your financial health, not just for compliance. Understanding how income and losses flow through, how specific expenses are treated differently, and critically, how your basis is calculated and maintained, these are all crucial pieces for navigating the tax landscape effectively as a business owner or partner. These seemingly small details can have really significant financial implications down the road, shaping your taxable income, the deductions you can claim, and ultimately, your net financial outcome.
So what does this all mean for you listening right now? It means you're now equipped with, hopefully, a powerful shortcut to being well-informed about a critical aspect of business finance. The next time you hear partnership income or Schedule K-1 or guaranteed payment or partner basis, you'll have a much clearer, more nuanced picture in your mind of what it actually means, both for the business and for your own personal taxes.
Absolutely. And for a final provocative thought to leave you with today, something to mull over. Given the incredible flexibility and the flow-through nature of partnerships and LLCs, and especially that concept of tax basis, how might strategically managing your partner's basis over time become one of your most powerful long-term tax planning tools? Especially when you're anticipating future losses you want to be able to deduct, or maybe planning for significant tax-efficient distributions from your growing business down the line. How can you proactively build or maintain basis? Something to think about until our next deep dive.
Great thought. Thanks for joining us on the deep dive. We'll see you next time.